Sharma is the chairman of Rockefeller International. He joins us live now. Thank you so much for being with us. I want to start with China because there has really been a string of negative data over the past couple of weeks. Just explain to us why China is really struggling so much to recover here.
Well, I think that the expectations out of China have not been reset sufficiently enough. As you know, that the Chinese economy now is undergoing some very major structural challenges. One of them is demographics. That's been well telegraphed. That for the first time in its recent history, the Chinese population is now actually shrinking. Its labor force is declining. No country in the history of economic development has been able to grow at a rate of more than 2% when its labor force has been shrinking, especially as much as China. The second issue has to do with the fact that China has massive levels of debt levels that are even higher than a developed countries such as the United States, if you look at the total debt. And that's also weighing down on the country. In a way, it's already borrowed a lot to grow in the past, but it's borrowed from the future. So I think that you have these structural headwinds out there, and a lot of people haven't quite adjusted their expectations to that, which is why I believe that the underlying trend growth in China this decade is likely to be in the 2 to 3% ballpark rather than the 5% target that the government has set, and also what many observers of China just like to follow whatever their government in China says.
And speaking of structural damage, I mean, it's highly likely that 2 years of COVID-19 lockdowns also contributed to major structural damage when it comes to the Chinese economy as well. Just what does this mean for global growth? You know, what China's going through right now and the fact that it's struggling to recover, what does that mean for global growth? Because China obviously does have a role as the engine for the rest of the world, the economic engine of the rest of the world.
Yeah, in this regard, I have to say that I'm a bit more optimistic. In fact, I'd written a piece in one of my columns in the Financial Times a couple of years ago, saying that the impact that China has on the rest of the world has begun to decline because the Chinese economy has turned more inward. It is less reliant also on external sources. And I think that what's happening, therefore, because of that, is that we saw this in the last few months. In fact, if you look at the first quarter data, that even other emerging markets that trade quite a bit with China have shown a lot more resilience than China has. So as you pointed out, that the Chinese economic growth has disappointed so far this year. But for the rest of the world, the US is well known, but even other emerging markets from India to Brazil, Indonesia to Poland, in all these countries, growth is actually surprising on the upside. So I think that the rest of the world has begun to readjust to a more inward China, to a world which is less dependent on China. And so therefore, the negative impulse coming from the Chinese growth disappointment is far less than what it used to be.
Ruchir, Sharma, live for us there. Thank you so much.